It's a pleasure to be here. Thank you, Michael, for inviting me. It's always important to know where somebody is coming from if they're talking. And where I'm coming from is along many decades of practical finance for 20 or 30 years as a fund manager. And after a while, it gets a bit tedious exploiting the mispricings of markets, which the academics say don't exist. So I felt there was a fundamental problem in finance and the way it was understood and taught. And so 7 years ago, before the world fell apart, I set up a Centre for the Study of Capital Market Dysfunctionality at the London School of Economics. That's where I'm coming from. And our objective is to write a better understanding of how finance works and how finance fails. And nodding in the direction of the title of this afternoon's conference, it's called Capital Market Benchmarks Set Finance in a Spin. So it's taking one part of the work we're doing at LSE. The subtitle is Two Cheers for Free Markets, borrowing from E.M. Forster, sort of, who said two cheers for democracy. I'm absolutely in favor of free markets, but they don't work how we're supposed to understand that they do. I hope you can all see this. The topic is to do with benchmarks, and what I want to explain is what happens when, in that contract that Anthony put up for the 28 years of asset management, market cap benchmarks constitute, for instance, indices or peer groups based on market cap. Typically, at least until a few years ago, measurement was based on comparing performance of a manager, or indeed your own portfolio, against the benchmark of an index, equity index, bond index, global, local, whatever. But the market benchmarks that what I'm going to show is that action of setting benchmarks to a manager causes, in aggregate, if everybody's doing it, the aggregate outcome is that some sectors of the market will be overpriced relative to their fundamental value. Others will be underpriced. The aggregate market will be overpriced, so the overpricings exceed the underpricings. And that high-risk securities will deliver lower returns than low-risk securities, which is contrary to the fundamental theory of finance as it's taught, and indeed our general understanding. We assume that if we take higher risk, we'll be rewarded with a higher return. That ain't in the data. It ain't in the data for 70 years. So there's something fundamentally wrong with both the teaching of finance and also the way practitioners and indeed policymakers are acting. What happens is, in a nutshell, that giving market cap benchmarks forces managers who manage the money to become more short-term, so it's short-termism, and with that short-termism comes not only a private cost, people don't do as well as they could do, but there's a societal cost in that markets will be disruptive. And what I'm talking about isn't a polemic. It's based on a very formal theoretical understanding, and it's also based on it's not a behavioral, judgmental, it's actually a formal theory in a rational framework. Now, what do benchmarks do? They're typically indices, as I said, or peer comparisons. So a pension fund will compare itself with other pension funds in the same country. The benchmarks are either explicit, i.e. they're in the contracts that are written, or they're implicit. The manager will always be looking over his shoulder to see how others are doing, and act in part under the influence of what others are doing. And both market indices and peer comparisons are, of course, based on market cap. The peer comparisons are because that depends on how markets are moving and how people are investing, how the competitors are acting. Now, there's a fundamental fact in standard theory of finance which has been totally ignored when we come to investment and asset pricing and so forth, which is that investors, for the most part, don't invest for themselves. The asset owner, all of us actually in our individual capacity, we delegate. We delegate it to trustees. Trustees delegate it to fund managers. There's a huge delegation process, a tiering of delegation, a tiering of agents. And that gives rise to asymmetric information. Asymmetric information, what does that mean? Well, if you delegate, finance isn't like any other product or service. You can take a washing machine that doesn't work back to John Lewis. You can't take a financial product that fails and get your money back. Finance is unlike pretty well anything else, in that you don't know if it's any good until it's too late. And the problem is that, people think, well, obviously the agent has more information. And here, just think in terms of the investor who delegates to a fund manager, the agent. The agent, obviously he has better knowledge. That's why he's given the powers. The powers are transferred to him to invest. But he's also got different objectives. He wants to make money for himself, which is perfectly logical, rational. Actually, the main problem isn't perversity in that sense. It's actually very simply that the principal does not know if the agent is competent and diligent. Simply that. That is the key fundamental problem. And so principals seek to limit moral hazard, which is people acting in ways that are not in the interest of the ultimate asset owner, and adverse selection, which is choosing the wrong guy or to do the wrong thing. Actually, what I'm going to talk about doesn't even have to involve delegation, because we're always looking over our shoulder at what everybody else is doing and also what markets are doing. So, but we'll think of it in terms of the trustee appointing a fund manager. What I'm going to say is based on, at the footnote at the bottom there, my colleagues who at LSE, Professor Vianos, Buffer, and incidentally, my colleague is a young chap called Buffer, and I'm the old Buffer in the trio. I won't go into the technicalities, but you can get a broad idea what goes wrong. Because when you have a benchmark, when you set a benchmark, when you set the manager to outperform the FT all-share index typically you expect them to outperform, you ask them to outperform by 2% a year, the index maybe 4%, with a tracking error, a divergence that you wish that 2 years out of 3, that you hope that 2 years, it's managed in a way that 2 years out of 3, the manager who is seeking 2% outperformance doesn't diverge by more than 4% or 5% from the market benchmark. The point is that if you are managing money to a benchmark, it causes the manager to focus on the most volatile stocks. if a volatile stock, say a tech stock in the tech bubble 14 years ago, if following a rise in technology stocks generally, and if the manager's underweight, he will be obliged to comply with the contract. He'll be obliged to add to his weights in those volatile stocks. There's less pressure to sell if he's overweight. And also, the pressure is greater for stocks that rise because mistakes are more costly. If something falls and you're overweight, your problems get smaller. They get greater, however, if you're short of something that's rising. It isn't only the benchmarks that the manager is given and the index that he's tracked. It's also his own commercial risk. So even if there's nothing in the contract, out of commercial risk, he'll seek to minimize his divergence from the market cap index. And it is that problem that I just explained in a very simple framework. It is that problem that arises when you give a manager a benchmark of a market cap index with some maximum divergence, then that will give rise to the overpricing of some stocks and some sectors. And it was key to what was happening in the tech bubble. I was, at that time, a fund manager, and we were underweight in tech stocks because we deemed them to be poor value. And the pain got greater and greater, and some clients simply obliged us to reduce our divergence from the index weight. And what this causes is it's one explanation for bubbles. It's this problem of everybody looking at their benchmark and seeking to keep in touch with it, not diverge too much. It is that which is one of the actual problems in misvaluation and bubbles, market cap bubbles. It's not the only one, there are others, of course, but it's a very important one. It is there are a number of reasons why bubbles are formed, but the key thing is that what I just explained, is the key fact why high-risk stocks, more volatile stocks, get overpriced. And why low-beta stocks actually deliver higher returns in the long run. Just to give you some historic data, it's called the beta anomaly, and what that means is it's the risk anomaly. It's how the market gets things wrong and how the theory is completely upside down. We've baked an upside down cake. US equities in 40 years, if you look at the low beta, low risk stocks, their return has been an average 10% a year, compared with the high-risk stocks, which you expect to offer a higher return, delivering only 7.2 on average. The risk is also lower, of course, in low-risk stocks, and it's higher in high-risk, which means the risk-adjusted return is something like 2 or 3 times greater for low-risk stocks than it is for high-risk stocks. And the same is evident in global equities, actually to an even greater extent than in US equities. Well, the central pillar of teaching in finance, academic teaching in finance, is the capital asset pricing model, that high risk is rewarded with high return. Well, that is wrong, plain wrong. The evidence is totally different. It's the elephant in the room. Academics have really almost ignored it. And the two explanations to date are, one, constraints on short selling, because people can't sell stocks they don't have because they think they're overvalued. So if you can't do that, that will lead to overvaluations. The second is that investors buy high-risk stocks because they have borrowing constraints, and therefore they want to get the biggest bang for their buck, so they buy the high-risk stocks. Well, we're talking about a misvaluation here, which is a massive distortion. It's a distortion, the fact that high-risk stocks deliver low return, and conversely, it is affecting the valuation of $100 trillion of market cap in equities, and another 500 trillion of derivatives, all based on it. So there's something all priced off the underlying. I said we're seeking to rewrite finance theory. I regard the theory of efficient markets, which has been around formally stated thanks to Eugene Fama. I mean, it's a great theory, but it's a special and limiting case. It's a special limiting case. Natural scientists don't work in a world in which there's a perfect vacuum or zero friction or zero gravity. They have a general theory. We do not have a general theory of asset pricing in finance. We're working to a special and limiting case that markets are efficient, prices are right, markets are self-stabilizing. Well, you can't use a theory that predicts perfection to address and tell you how to act in conditions of imperfection, whether you're an individual investor or whether you're a policymaker. And yet that is the rule book that everybody is working to. They might recognize, and they do recognize, that markets are inefficient, but their toolbox is based entirely on the traditional theory of efficient markets, and it tells them to do almost diametrically the opposite of what they should be doing. And what we show is that, in fact, people talk about short-termism, and they think in terms of people riding waves, riding trends, buying for the short run to make a quick buck, like a hedge fund with a shorter investment horizon. But actually, most short-termism, the most damaging part of short-termism is actually trying to track a market cap benchmark, trying to keep in touch with an index or a peer group performance. So, in fact, short-termism is the elephant in the room. And it isn't about a holding period. It's actually about how you're investing, the strategy you're adopting. It is not about a holding period. That's so important. It amounts to whether you're using momentum to buy something that's going up and sell something that's going down, or whether you invest on the basis of fundamental value. What are the implications of the new theory that we are constructing, which is a general theory of asset pricing based simply on recognizing that investors delegate for the most part, and that there is this asymmetric information, a misunderstanding or lack of understanding, a lack of clarity and opacity on the products and the management of funds. The implications are that, for example, that passive investors, they may save money on management fees, but they're actually investing in stocks that are mispriced. In most cases, half of what they're holding is overpriced stocks. They're just taking what the market delivers, and the market actually delivers a distorted outcome. That's the key point. So passive isn't isn't clever. It's clever at dealing with the delegation cost, and everybody's talking about that now. But there's a bigger problem, which is it causing people to invest in the wrong categories, putting too much in the overvalued stocks and not enough in the cheap stocks. There isn't time to go into. I mean, you might say, well, okay, you've given one explanation of how markets get distorted, but aren't there enough people investing sensibly based on fundamental value to counter this? I mean, why aren't people taking advantage of this mispricing? The bulk of investment is this is probably the. I'll just skip to this important graph. If you don't actually remember anything that I've said particularly, except bear this in mind, that our model enables us to show what the returns are to different strategies. Because we have a theory, a general theory of asset pricing and asset mispricing, unlike the traditional approach, we can show that what the returns are to either of the two strategies. And essentially, investment management might be dressed up in all sorts of ways, but there are only two strategies: trend following, or buying stuff that's going up, selling stuff that's going down, or fundamental value, investing on the basis. And fundamental value includes buying growth stocks, because you look at, the important thing is you're looking at the underlying earning power, the future cash flows from the investment. That's fundamental, that's value. And this graph shows that the solid blue line is the investment horizon. The Sharpe ratio is the risk-adjusted return from the two strategies, value and momentum. The horizon, the length of period over which you apply this strategy, is on the horizontal axis. And it shows that the annualized, and these are the annualized returns, the annualized risk-adjusted returns, Sharpe ratio. It shows that momentum, which is a succession of independent bets, because you buy something, you hold it for 3 or 6 months, sell it, regardless of whether it's cheap or dear at the end of the period, because you're investing simply based on riding trends. Blue line is the returns, annualized returns to momentum. The point about value, however, if you buy, and value is the green dotted line, there's a danger if you're a value investor that you're going to be investing at a point when things are cheap, but they get even cheaper. And that's why, it's a little more complicated than that, but that's why the returns to value in the short run, in the first year or two, are prospectively below those from momentum. But the returns to fundamental investment exceed those from a momentum strategy in the long run. Pension funds are long-run funds, and they should all be invested based on fundamental value. It's the fact that momentum, which is a short-term strategy, either to reduce risk or to make short-term money, momentum, the bulk of what you're paying all your managers to do is actually just to follow momentum for the large part. And it's disastrous to the outcome of markets and indeed your private performance. And the nutshell is that asset owners and trustees, for instance, of pension funds should select not market cap-based benchmarks, but real benchmarks. They should write contracts that lengthen the horizon of the investor, of the manager, and reduce trading. I mean, frankly, all you need to do to deal with momentum is to just tell your manager not to trade 100% of your portfolio a year. Cut it down to 20%. That's all you need to do. I mean, you don't have to have a lot of gobbledygook or regulatory stuff. Simply just question, why is my... If anybody's using a turnover of over 20 or 30%, it means that they're using momentum. They're doing short-term strategies, which in the long run will fail you badly and will that are creating the problems. Oh, that was funny. I didn't. I thought I just got the starting slide, but okay. Well, that's it. Thank you very much indeed.